Prediction markets like Polymarket show a 75% chance of a soft landing by 2026, but institutional models like UBS assign a massive 93% probability to a recession. That is a massive gap in expectations. Usually when the economy stumbles, the Federal Reserve steps in to catch it by cutting interest rates. That makes borrowing cheaper and stimulates growth. But right now, Federal Reserve Chair Jerome Powell doesn't have that option. The reason is sticky inflation. Currently sitting at 3.3%, inflation has stubbornly refused to drop to the Fed's 2% target. This thick, pervasive price pressure traps policymakers, forcing them to keep interest rates elevated to prevent costs from spiraling further. And those prices are being squeezed by forces completely outside the Fed's control. Rising geopolitical tensions in the Middle East directly threaten global energy supplies, which pushes up the cost of oil and gasoline here at home. Meanwhile, the U.S. government is carrying an astonishing $39 trillion in national debt. With interest payments surging past $1 trillion a year, the government simply cannot afford to borrow its way out of a crisis with massive stimulus spending. The traditional safety nets are gone. High debt neutralizes government bailouts, and sticky inflation neutralizes the Fed. The economy is operating without a parachute. If we look at this diagram, top-line GDP growth is still hovering in positive territory, around 2%. On the surface, that looks fine. But a second metric tells a different story. That metric is gross output, tracking total economic activity throughout the entire supply chain. As you can see, the trend line for business-to-business spending has essentially flatlined. The supply chain is stalling out. With corporate investment grinding to a halt, the only thing keeping that top-line GDP number positive is consumer spending. When business growth stalls, the entire weight of the economy falls onto the everyday shopper. If the consumer buckles, the whole structure comes down. This graph illustrates the K-shaped economy, where financial realities aggressively split into two distinct paths. Following the upward arm, the top 20% of earners, propelled by surging asset prices and AI investments, account for a full 60% of all consumption. But the downward arm represents the bottom half of the economy. Down here, sticky inflation is rapidly outpacing real wage increases, eroding daily purchasing power. The United States is now a dual economy, with two parallel realities operating under a completely different set of financial laws. And this chart reveals exactly how that bottom half is managing to survive. To keep up with the rising cost of living, consumers are borrowing heavily, driving total credit card debt violently past the $1 trillion mark. A financial system can't run on high-interest credit indefinitely. The strain is showing, with auto repossessions climbing to their highest rates since the Great Recession. At the same time, banks are rejecting mortgage refinance applications at record levels. Lenders are closely examining consumer balance sheets and seeing clear signs of insolvency. Since consumer spending accounts for 70% of all GDP, the economy remains stable only as long as that debt can be serviced. Once those credit limits are reached, the primary engine of national growth effectively loses its fuel. You cannot control the Federal Reserve, you cannot dictate tariff policies, and you certainly can't resolve tensions in the Middle East. Your focus has to shift entirely to fortifying your own personal microeconomy. The absolute first step to survival is clearing your liabilities using the debt snowball method. By systematically paying off your smallest high-interest debts first, you free up the cash flow and gain the psychological momentum needed to attack the larger balances. Once the high-interest debt is cleared, you need to build a cash cushion. That means saving up enough liquid cash to cover 3 to 6 months of absolute baseline living expenses. The most effective tactic here is automation. Set up automatic transfers so that your savings are immediately routed to a separate high-yield account, psychologically quarantining that money away from your daily spending habits. Liquid cash and zero high-interest debt are the only reliable shields against a macroeconomic shock. With unemployment creeping up to 4.3% and companies actively looking to replace white-collar roles with artificial intelligence, your income is also a vulnerability. To protect your career, you have to pivot. Instead of competing against automation, upskill yourself to command it. By using AI tools to augment your own output, you transition from being a redundant expense to an indispensable asset. Securing your liquidity transforms a crisis into a strategic advantage. When a recession forces asset prices down, those with cash and no debt can buy high-quality companies at a discount. Wealth is built by having the resources to buy while the rest of the market is forced to sell. Defensive strategic investing during these periods means looking for stability and value. This includes broad index ETFs, stable large-cap companies with strong balance sheets, and surging commodities like physical gold and silver. The macroeconomic weather forecast for 2026 calls for severe turbulence. But by mastering your budget, eliminating your debt, and upskilling your career, you can build a personal microeconomy capable of thriving in the storm.